يا الله يا الله يا الله. ادخل شراء، بسم الله. دخلنا صفقة شرائية. اغلق لي نص العقد حبيبي. نزل ستوبك، خليه تحت الشمعة الحالية. إذا ضرب ستوب نطلع بربح، لأن ستوبك 4 نقاط وأغلقنا نص العقد على 10. يا كريم. حجي اغلق لي جزء بعد من الصفحة حتى ترجع ضرب الستون تطلع ربع أكثر. بقى 0.03 من الصفقة فقط.
السلام عليكم.
وعليكم السلام ورحمة الله.
شو أخبار السحرية اليوم؟ نفسها
نفسها إن شاء الله.
إن شاء الله. زين، شنو فوق المستوى الأخير؟ عودة ذا صار مجال عودة أفضل أكتب في المستوى الواحد.
المستوى الأخير؟
هو بعد ما وصل. تمام.
بعد ما وصل 56 حياتي.
هو قصدي أنا بالي أسأل شنو الفوق نسيت.
بس يوصل بإذن الله نحدث. حيل الله.
إن شاء الله.
Guidance that micromanage by rewarding economies Trump was sworn into office, the administration began rolling back the responsible bank innovation in crypto and other blockchain technologies and imposed arbitrary restrictions on incentive compensation. These binary era proposals were bad for banks, bad for business, and bad for America, especially Main Street. So President Trump slashed all of them. To restore the strength of community banks, the new administration has replaced this draconian agenda with a new, more constructive agenda. The FDIC, for example, has recommitted to tailoring by proposing to raise and index asset thresholds. It has streamlined examination procedures and branch applications. It has started work to reestablish a supervisory appeals body. Not to be outdone, the OCC has implemented its own reports. Controller Gould has been on the job for only 12 weeks, but he has already reduced assessments on small banks by 30%, reversed the plan to merge community bank supervision into large bank supervision, and replaced community banks' formulaic examination schedule with a more risk-based approach. Vice Chair Bowman, meanwhile, has long advocated for revisiting the community bank leverage ratio. I expect that effort will soon culminate in a proposed reduction in the community bank leverage ratio. The CFPB, for its part, has started to revamp the Section 1071 reporting requirements and reconsider the open banking rule. And it has withdrawn more than 60 interpretive rules and other guidance documents. Following the administration's example, Congress has also taken up the effort. It has nullified the CFPB's overdraft rule and prohibited the furnishing of mortgage-related trigger leads. The House Financial Services Committee has likewise advanced 24 important reforms to community bank regulation, while the Senate Banking Committee held a hearing and hopefully will soon mark up an expansion of FDIC insurance on non-interest-bearing transaction accounts. There is still much to look forward to on the regulatory front. This includes 2 new proposals that will reset the culture of supervision. 2 days ago, the FDIC and the OCC proposed a rule that would codify the recently adopted prohibition on using reputation risk as a basis for supervisory criticism. The FDIC and the OCC also proposed a rule that would define unsafe or unsound practice or condition. While simply defining a term might sound like a small thing, it marks a big step forward. Only in the world of unaccountable regulators could a key concept have gone unidentified for so long. The past failure to define this term led to supervisory criticism focused on process or documentation related to governance, model management, and third-party risk management. In other words, topics that often had little or nothing to do with a bank's actual financial condition. This regulatory myopia was the driving force behind the spring of 2020-23 bank failures. Once finalized, a clear focus on material financial risk will put an end to this nonsense. I'm also optimistic about AML CFT reform. In my meetings with community bankers, they list CTR filings, structuring SARs, and process-focused examinations among their top concerns. Today, FinCEN released FAQs to address pain points in some of these issues, including triggers for restructuring SARs, continuing activity reviews, and the absence of any requirement to document a decision not to file a SAR. These are common sense, yet consequential reforms that will ease regulatory burdens without undermining law enforcement efforts. As part of our broader campaign to modernize illicit finance regulation, FinCEN and the bank regulators are hard at work on a new rule to define the requirements for an effective AML CFT program. My expectation is that a proposal will recenter supervision where it should be, on the effectiveness of a bank's AML CFT program. I likewise expect that proposal will position FinCEN as a gatekeeper for AML CFT enforcement. This will be a significant departure from the past, with its zero-tolerance focus on process, documentation, and wide latitude for supervisory expectations and judgments that are not always consistent with the law or our national security priorities. A focus on higher value activities will also better serve our law enforcement and national security objectives. These are all important victories, to be sure, but much work remains to be done. Where do we go from here? Going forward, Treasury will continue to drive reforms to improve regulatory tailoring, refocus the culture of supervision, and modernize our illicit finance regulation. Specific priorities will include reforms to the rating system, new processes for monitoring and examining compliance with supervisory policy, mechanisms for independent appeals of supervisory criticisms, coordination to avoid duplicative examinations by different regulators, and review of the core platform providers, including contract terms that prevent community banks from innovating for the future. For community banks to go back on the offensive, we need to take a closer look at the dynamics that have undermined the community bank model and work to fix them. To that end, as I have said before, Treasury is focused on ensuring that modernization of our capital framework ends the capital arbitrage that drives bank lending to non-banks. This will likely entail reduced capital requirements for large banks on mortgage loans, investment-grade corporate loans, and some other important exposures. We must therefore ensure parity by giving smaller banks at least the option to benefit from these reduced requirements. Treasury has also supported congressional efforts to modernize the deposit insurance framework. I'm encouraged to see emerging bipartisan support for increasing FDIC insurance limits on non-interest-bearing transaction accounts. In addition to these efforts, Treasury has taken an informed and careful approach to Fannie Mae and Freddie Mac. Any actions on the GSEs must not increase borrowing costs and must preserve what works in the current system. That includes the prohibition on volume-based discounts for large lenders, as well as the cash window and other features that preserve equal secondary market access for small lenders. Now, allow me to close with a call for action. Before President Trump took office, community banks spent decades on the defense. But under President Trump's leadership, the game has changed. The playing field will be even more even. The ball's in your hands again. What happens next is up to you. So my advice, go on the offense, retake market share, chase after customers, champion technology, leverage the new regulatory landscape to your advantage, and expand your role in the American economy. The community bank comeback will help pave the way for America's golden age. Recognize the outsized role you play in this effort and embrace it. Because if you lead the way, Main Street will follow. Thank you.
Thank you, Evolution, thank you.
Thank you, Secretary Besson. It's wonderful to hear a Treasury Secretary. I'm not sure I've ever heard a Treasury Secretary talk about community banking and the importance of community banks in the United States and for the U.S. economy in my lifetime. So it's really refreshing to hear you engaging on things that are so important to areas like where I'm from and rural communities across this country, and how important community banking is for the foundation of our economy and the economic system. So if you don't mind, we'll start with a question, and thank you for joining me for some a fireside chat this morning. But as Treasury Secretary, you oversee U.S. fiscal.
Well, I come with some good news this morning, and Treasury, because of the Schumer shutdown, will not be able to release the exact numbers, but the CBO jumped the gun a bit, and it was on Bloomberg this morning that the deficit for this fiscal year, ending September 30th, will be slightly lower. When I went to see President Trump 2 weeks, and more importantly, the deficit to GDP now has a 5 in front of it. So according to the CBO numbers, we don't have the Treasury numbers yet, the deficit to GDP will have fallen from about 6.5%, which was the highest when we weren't at war or weren't in a recession in U.S. history, to 5.9%. When I went to see President Trump approximately 2 years ago to tell him that I'd like to come out from behind my desk and get involved with the campaign,
خلي ايدك على البيع انتظر.
many private conversations, but this was particularly notable. He looked at me, first thing he said,
ادخل
"Scott,
بيع
how
بسم
are we
الله.
going to get the debt and deficits down and not cause a recession?" And we're on our own. I think we saw that today. So I think the president's economic policy, as many of you would have seen me say before, is a three-legged stool: trade, tax, and deregulation. The tax bill, a one big, beautiful bill, has incentives for both
اغلق نص.
corporate America,
خلي اسلوبك على الذين المشمة الحالية.
for plant property and equipment, and the plant part is new. In the tax cuts
اغلق جزء من العقد
in
بعد.
2017, there was full expensing for equipment, but we have added industrial structures and, importantly, agricultural structures. So, secondly, on the other side of the ledger, it also includes the policies, the campaign promises for working Americans: no tax and tips, no tax and overtime, and interest deductibility if you buy an American car. One of the things that we are seeing now, most
شكرا خدنا منه خوش روح.
to reflect this.
هسه بعد اغلاق